So recently, my friend Chicken brought up a really interesting topic where he mentioned that we might see a lost decade in the future. A lost decade is a period where the market basically gives zero return for many years. This is a chart of the real S&P 500 index, meaning it's adjusted for inflation. You can see that since the early 1900s all the way till now, we have experienced 3 huge lost decades, ranging from 13 years all the way to 52 years. But wait, surely that is not possible now, right? The market has been doing fantastic lately, with it beating all-time highs, company earnings have been growing strong, the economy is growing strong, and even the Fed is going to lower interest rates soon. Not quite. A famous hedge fund manager, Ray Dalio, who manages billions of dollars of assets, has warned that the US is facing a big cycle debt crisis and we might see a lost decade in the future. So, in this video, I'll be going through everything you need to know about the lost decade. What could cause it? Will it really happen? And if so, what should you do now? Also, do join my Telegram chat group t.me/KelvinWest to discuss or ask any questions that you may have. Interestingly, lost decades are extremely common. This is the Dow Jones, where it also saw lost decades that lasted anywhere from 12 years all the way to 25 years. Australia's All Ordinaries Index, where the latest lost decade lasted 46 years. UK's FTSE 100 Index, Dutch AES Index, Japan's Nikkei 225 Index, China's SSE Composite Index, even Singapore's Straits Times Index is in the lost decade now. In fact, if we just look back at the S&P 500 chart, since 1900 till now, the market has been stuck in lost decades 75% of the time. So, in terms of probability, the fact that right now we aren't in a lost decade is pretty unusual. So then, what causes a lost decade? 3 reasons: war, overvaluation, and a stagnant economy. If we look at the US stock market in the early 1900s, the lost decade was caused by World War I. Later on, in the 1930s, there was World War II and the Great Depression. 1970s, the Great Inflation, 2000s, the dot-com bubble, followed by the 2008 financial crisis. But right after that, the S&P 500 started its best bull run in history, where it ran up by 560% from 2009 till now, giving an amazing 37% average return over the past 15 years. So then, what caused this amazing bull run to happen? Was it because of the tech boom? Or a strong US economy? Partially yes. But the underlying reasons are a lot crazier. First, we are in one of the lowest interest rate environments ever in history. From 2008 all the way to 2015, interest rates were practically zero. Low interest rates are good for the economy and the stock market because it makes borrowing super cheap and stimulates consumer spending, which in turn will boost corporate earnings growth. Similarly, interest rates were also rather low back in the 1950s. And what happened to the stock market? Yup, it broke out of another lost decade and continued all the way till 1965, when interest rates shot up again. The other thing which helped the crazy bull run is the infamous money printing. You see, back in 1971, the US left the Bretton Woods Agreement, and they no longer have to peg their currency to gold. This allowed the government to start printing more money in order to finance spending and boost economic growth. And we can see that there's a near perfect correlation between M2 money supply and the stock market performance. So then, how long will this continue? Will interest rates stay low forever? And can the US print money forever?
Maybe, maybe not.
But the main reason why the US can print so much money and not experience hyperinflation is because its debt is in US dollar. So they can just print more money in order to pay back their debt. The US dollar is also the world's largest reserve currency. International trades are mostly done using the dollar, and central banks from all across the world hold the US dollar in their reserves. However, what many of these countries learned over the past few years is that as the US prints more money, other countries will experience inflation as they need to spend more of their currency to purchase goods and services priced in the US dollar. That's why more and more countries are trying to move away from the US dollar. This is exactly what Ray Dalio warned about in his Changing World Order, where he predicts that one day the US will lose its power and other countries will take its place. But of course, given that the US dollar is still the world's largest reserve currency and the US is still the world's largest economy, chances are we won't see a changing world order happening in the near future. Quick pause. With Tiger Brokers Auto Invest, you are now able to automate your investments. This helps you make sure you are consistently investing on a regular basis while minimizing the impact of bad market timing. To set up Auto Invest, Just open up the US stock that you want to invest in, then tap on the Auto Invest button near the bottom left, and here you can start investing with as little as $2. What's nice is that Tiger Brokers lets you deduct the funds directly from your bank account, thereby saving you the hassle of manually transferring the money over. You will then be able to automatically invest every trading day all the way to every month. Besides that, Tiger Brokers has also just launched their very own Tiger Boss debit card. You can apply for this card for free via the Tiger Trade app, and with it, you will get to enjoy competitive FX rates for international spending, as well as receive 1% of your eligible spend in Tesla fractional shares from now to 30th April 2024. Tiger Brokers is also running a welcome promotion. If you sign up using my link down below, find your account with 1,500 SGD, hold it for 7 days while completing 5 buy trades, you will earn $40 worth of Apple fractional shares, 1 free stock worth up to 888 SGD, and an exclusive $30 worth of Tesla fractional shares. On top of that, you will also get 0 commission trades for US stocks for 180 days and other markets for 365 days. Though, take note that other fees will still apply. So, if you are interested, you can sign up using my link down below. With that being said, let's get back to the video. Besides that, Ray Dalio also warned that we might see a reversal of the strong growth seen over the years, and that could eventually lead to a lost decade. Globalization, which is the largest driver of our profitability, has already peaked, and with the US-China conflict going on, companies are starting to move their supply chains out of China and is focusing on reliability as opposed to just cost optimization. And we are starting to see this happening, where big companies like Apple, Intel, and 1/5 of US businesses are looking to move some of their operations out of China. But perhaps a bigger concern right now is overvaluation, as big crashes tend to happen whenever the market becomes overvalued. Right now, even though the S&P 500 PE ratio has dropped from its peak, it is still at a rather high 26 PE ratio, as compared to the average PE ratio of just 16. Or we can also look at the Buffett indicator, which also shows that the market is overvalued now. Okay, maybe this is because the S&P 500 is experiencing higher growth now due to all the AI boom. In that case, we can look at the forward PE ratio, which shows that it is above both the 5-year and 10-year average. Or how about the PEG ratio, where instead of looking at the forward 1-year expected earnings growth, we look at the forward 5 years expected earnings growth. And again, it shows that the S&P 500 is still overvalued. Now, of course, just because the market is overvalued doesn't mean that it will crash tomorrow.
Or maybe it will.
But looking at history, we tend to get high returns when we start at the bottom and low returns when we start at the top. This is also the reason why Vanguard believes that even though US stocks have been outperforming international stocks over the past 10 years, this trend may not continue over the next 10 years, as international stocks may outperform US stocks due to reasons such as valuation expansion, higher dividend yield, and the rise in foreign exchange. Here's another chart by JP Morgan, which shows that the higher the forward PE, the lower the 5-year annualized returns. And this chart by Credit Suisse shows that the higher the real interest rates, the higher the real asset returns over the next 5 years. But why like that? Shouldn't lower interest rates equal higher returns? Not quite, because remember, stocks tend to perform worse off when interest rates are high. So when interest rates eventually come back down, that's when assets tend to perform better in the future. Case in point, Credit Suisse also found that because interest rates were higher in the past generations experienced higher returns. But as interest rates slowly come down, future generations will experience lower returns during their time. The other thing we can count on is mean reversion, where given enough time, things will normalize back to its average. So right now, the US is leading in terms of forward PE. However, this wasn't always the case. Over 100 years ago, the UK was actually leading in terms of stock market size, while the US was only 15%. But now, the US stock market has grown to almost 60%. Or even in just the past 40 years, there were times when the emerging market outperformed the developed markets. Other times, the developed market outperformed the emerging markets. In short, almost every analyst and every data that we have looked at is now predicting that the US equities will give lower returns in the future. So, what's the point of knowing all this? I think this is an important reminder to us that we shouldn't just focus all our investments in the US. Because even though the US has performed really well over the past 15 years, this doesn't mean that it will continue doing well in the future. But of course, you can say that obviously the lost decade only affects someone who only invests once during the start of the lost decade and stops investing after that ma. But what history has shown us is that this is very much dependent on luck. For example, if you were to dollar cost average into the S&P 500 over 20 years, as shown on the green line here, if your year ended in 1920 or 1980 or 2009, you will still end up with negative returns. To avoid the effects of a lost decade, you will need to invest for at least 30 to 40 years. This is especially important if you are someone who's betting on US high growth to achieve your financial independence retire early plan in 10 years or whatever. Like if I invest $5,000 into S&P 500 every month with its average 10% annual return, I will get $1 million in 10 years time. No, yeah, this doesn't always work, yeah. So then, knowing all this, what can you do? Short answer, diversify. Make sure to diversify your investments. Sometimes US equities will do well. Other times, it can be emerging markets or China equities or Japan equities. An easy way to diversify is to just buy an all-world ETF, such as VWRA, where besides the North America, the ETF also holds investments from other regions, such as the Pacific, Middle East, emerging markets, and Europe. Besides diversifying across regions, you can also diversify across asset classes. For example, if you are someone from Singapore or Malaysia, make sure to top up your CPF or EPF. While the returns are a lot lower than investing in equities, this will give you a good safety net in case things go wrong. Anyway, that's all for this video. Hopefully, you found this useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.